So first of all, let's take a look at the key figures. As the Hypoport Group as a whole, we are on a growth trajectory. We have a double-digit increase in the top line, as well as in the corresponding dynamic earnings development. A doubling compared to before, coming from a low level, as you know. This is strongly driven by the real estate and mortgage platform segment. Here, we have recorded a significant increase. Here, we have tailwinds from the market, and in addition, we are able to monetize more strongly and leverage the economies of scale. But the financing platform has also contributed positively to the earnings development, even though the market environment here is somewhat weaker and also diverse. The insurance platforms are still struggling to break even. A lot of progress in detail, but monetization still needs to happen. The most important highlight for us, aside from this segment analysis, is the development of our ERP platform for the housing industry. Here we continue to have a highly dynamic customer acquisition pipeline. We are very successful in the housing industry with the ERP system Hypoport and the connected systems. More on that in a moment. Okay, let's dive into the segments. We'll start with the largest segment, real estate and mortgage platform. This is tied to the topic of home ownership in Germany. As you know, the acquisition, purchase, and construction of home ownership has traditionally been a stable market environment in Germany. We experienced some turbulence in the market and a temporary freeze during the massive interest rate changes we saw in 2022. We are no longer seeing this in the first 9 months of 2025. We have a stable interest rate environment, you could say, still at an attractive level for home ownership acquisition. We have a well-stocked stack of properties for sale on the market. In fact, in Q3, we even saw a new record high. The number of properties on offer hasn't been this high in the last 5 years as it is right now. Of course, this varies slightly by region. In the metropolitan regions, it's already becoming scarce again. There is no longer a given to quickly find the right apartment, even if you have the creditworthiness and can afford it. In the outlying areas, and especially in the regions experiencing population decline in Germany, the supply of real estate continues to rise, with corresponding effects on prices. Looking at Germany as a whole, both the prices for condominiums and for single-family homes have risen slightly over the course of this year. You can see that from the red and the gray line. There has also been a slight upward trend in the last 3 months. So in this respect, the trend is intact and is being driven by the metropolitan regions. There, prices are already rising dynamically again because high demand is once more meeting a limited supply. In the regions people are moving away from, prices are at best stable or even falling. But these are so to speak, underrepresented in the nationwide average. New construction costs remain consistently high in Germany. One could now say thanks to regulation. This is also one reason why residential property prices will continue to rise in the future. Because the gap that has formed over the past 5 years between the value development of existing properties and new properties cannot be explained solely by energy efficiency, but also simply by the fact that there is currently an opportunity in the market to buy existing properties more cheaply relative to the cost of new construction than was previously the case. Overall, the owner-occupied and property market has been massively supported by the fact that an overregulated rental market has been temporarily frozen and supply remains at an extremely low level. That is hardly visible on the curve, if you will. The minus 20% compared to 2021 still paints a rather positive picture, since the overall German average is also reflected here, of course. In the metropolitan regions, the availability of rental apartments is even more restricted. Logically, in regions people are moving away from, it's easy to rent something quickly. But of course, for most people in Germany who are mobile and have the money, who are potential buyers of residential property, it is irrelevant that they can rent an apartment in the Thuringian forest. Moreover, even in 2021, the rental housing market was already characterized by an extreme shortage. In this respect, compared to that extreme shortage, the supply of rental apartments has dropped by another 20%. And the outlook for the future is bleak. Due to rent regulation, hardly any existing rental apartments are coming onto the market. Everyone who has a rental apartment stays in it because it's cheaper to stay than to move. New rental apartments are practically no longer being built, at least not what we would consider. rental apartments in the broad segment, and in the segment that is interesting for us, so to speak, the family forming segment. There is only new construction of rental apartments in marginal niche areas in Germany. So how has Hypoport Europe, the segment, basically performed? We always like to take another look at the four subsegments of the German real estate financing distribution market. The mortgage financing brokers, the independent distributors. Here we see a strong market share and a customer base, partnerships with independent advisors who are structurally gaining market share in a competitive market. Especially now, as household budgets are getting tighter again, brokers are the ones who, thanks to their agility, are taking business away from bank branches. With the cooperative banks and savings banks, we are each engaged in strategic partnerships with these groups, migrating structures onto the Europace platform, helping them remain competitive, not only against brokers but also against private banks. And with every structure migrated to Europace, we strengthen their competitiveness. At a major private bank, it has given up market share for strategic reasons. We are also affected by this because the overall business of this bank runs through us. We notice this somewhat in our figures. And yet we assume that private mortgage financing is a central component of every retail bank's strategy worldwide. And therefore, it is also important for German private banks to regain the market shares they may have recently lost. In the coming years, in terms of numbers, Europace is looking at an 18% increase for the first 9 months. Here you can see that from our perspective, the three most important subsegments, savings banks, cooperative banks, and our own franchise system, Dr. Klein, are each above the overall growth of the platform. This can only be explained by the fact that someone has given up market shares or platform shares, has given up. As I said, that was the private banking sector, which I just explained. Overall, we are seeing dynamic growth in all three subsegments. For private banks, everything will depend on the future. Now, if we take a closer look at the market from a different perspective, this year's growth is being driven by the financing of home purchases. You can see from the red bars that while they used to be the most important market segment, today they are the dominant market segment. We are seeing consistently high transaction numbers here, and this is happening even though property prices are still lower than in 2021. This means that the number of transactions we are financing for the purchase of residential property is currently at a record high. Overall, in the market, this figure is still significantly below the levels of 2021 and 2022. Here, you can see Europace's market share gains very clearly. In addition, there is a second market segment, which has historically always been the second largest, the construction of new residential property. In this area, we have slightly improved from the crisis years of 2023 and 2024 in terms of the volume being financed, but when it comes to new construction financing, which is a very early indicator of new construction activity, we are still lagging behind. We are still at a historically low level in Germany. So from the platform's perspective, we are operating at the level of 2019. Back then, however, Europace's overall market share was significantly smaller. This means that if we assume we are representative of the overall market, there is still very little new construction financing taking place. And that means that in the years 2026 and 2027, very few new construction projects will be completed, because right now hardly any are being financed. In this respect, it's also a good indicator that the pressure on the real estate market, on prices, and on the price gap between existing properties and new builds will remain high. Refinancing, meaning the restructuring of existing real estate loans, also remains low in the third quarter of this year. Here we are at a historically low level. Much of this can be explained by the sharp change in interest rates in 2022 and the fact that many consumers had already taken out 15 and 20-year fixed-rate loans and thus financing agreements beforehand. And yet, it is still surprising how little refinancing volume there actually is in the market. So it seems that a lot of equity is currently flowing into refinancing so that they don't have to take out new loans at the current interest rates. Now, something that is politically desired but still not happening at all is the energy-efficient modernization of existing buildings. Here we're talking about a historically low level. Investment in existing properties is low, and so is the financing for it. Clear political signals are missing here, as well as, if necessary, the corresponding changes to the regulatory framework, especially when it comes to structural renovations and the regulations that must be observed there, but also in terms of subsidies, so that the whole thing is economically attractive from the perspective of the individual, not just from a macroeconomic or global point of view. So far, we've always been able to talk about the problem child Value AG, where we've had a very long journey entering the market, finding our position in the market. Value AG is still weighing down the results with an operating loss of minus 2.4 million in the first 9 months, plus restructuring expenses of 1.8 million on top of that. However, we can see from the operational traction that we are making very good progress here and that all the measures we have taken are having an effect. So the efficiency within the Value AG organization is increasing and the share of digital products we are selling is also rising. I want to explicitly mention, for example, the One Value offering that is now available to the cooperative banking sector, a fully integrated valuation process within the advisory and loan origination process in cooperation with Europace. But we are also making progress with our digital offerings in other sectors, and we are managing to significantly increase efficiency in the areas that are not yet digitalized. All of this is now also accompanied by a positive development on the pricing side for our services, so that we continue to look very positively toward 2026 and expect that over the course of the year, we will have the IFA project operational there, meaning that Value AG will only have a minor impact on our results in the first half of 2026. This is a great success for the team there and will also have a positive effect on our segment figures. We can see here that we are able to take advantage of the normalization currently happening in the market to return to the segment's previous profitability, and this still includes the burdens from Value AG. We expect that this positive trend of a significant increase, a strong expansion in the segment's profitability, will continue both in the fourth quarter and into next year. That brings us to our second segment, the financing platform. Here, we are talking about 3 submarkets. The most important is the housing industry, where we are digitalizing another key part of the German housing market, specifically the social rental housing stock, which is held by formerly non-profit, cooperative, and municipal housing companies. We are digitalizing this from the financing side, supplementing everything with an ERP system, and we provide integrated solutions for portfolio management, rental deposit processing, and claims management in the insurance sector. This comprehensive platform has now existed for several years. Our success is measured by how well we manage to roll out Hypoport as a central component as an ERP system for the housing industry here. And in this respect, the key metric for you is especially important. How high is the number of residential units we have under contract on Hypoport? And that number compared to the previous year has meanwhile increased by 63%. So it's a nice curve with strong momentum where we have a lot of work with the initial migration of these newly acquired housing companies onto our platform, so that afterwards, together with you, we can enjoy the tremendous efficiency and the resulting profitability for the business model. In addition, we historically come from the brokerage of real estate financing, also for the housing industry. Here, in the first 9 months, we are also seeing an increase of 21%. However, this is still in a very subdued market environment. The housing industry rarely buys, it builds or modernizes. And what currently applies to the private home ownership market, that residential construction is only taking place to a limited extent, applies here as well, especially to the construction of rental housing. If there is any activity at all, it is only in the niche of social housing. And in the area of energy-efficient modernization, where huge investments worth billions are needed, the housing industry currently lacks the balance between the energy requirements for modernization and the government subsidies that would make all this manageable in the social housing sector. And for that reason, very little is happening there as well, even though it is an area with enormous potential. For the future, overall, the development in the housing industry is very positive, even though we still need to invest heavily here, because the further development and rollout of the ERP system OneSpot naturally still requires significant investment. But even here, we expect to reach break-even at the product level within the next 2 years, which will also lead to positive momentum in our earnings development. So the first submarket that is significantly more stressed than what we've seen in the previous, so to speak, housing-related markets. The German Mittelstand has now been in a recession for 6 consecutive quarters. This situation is due to the regulatory environment and political interventions. And even the current federal government has not yet managed to prevent the spirit of the German Mittelstand from being awakened again. So what we're missing here are the framework conditions for the Mittelstand to invest. We can sense from the project activities we have that there is a strong desire among entrepreneurs to take action here. There are countless projects ready and waiting to be implemented. What is still lacking are the political framework conditions. One could say that over the course of the fourth quarter, there have been a few positive impulses here. Whether these will actually take effect this year is something we still have to see. And so to speak, between first talking about it and then actually having it published in the law, unfortunately, many, many months still pass. And in this respect, together with our clients, we are waiting for the right framework conditions so that we can finally get started again. Basically, we have 4 projects to process and bill, but each of them comes with low subsidy amounts and therefore also low revenue structures on our side. The fourth quarter is always particularly special here due to seasonal factors. This year as well, we are expecting a strong fourth quarter. But the framework conditions also need to continue to develop positively for 2026, and we, as Germany, as German industry, and especially the German Mittelstand, need to do our part to get out of the recession again. So a recessionary environment also has an impact on the consumer credit business in Germany. Unsecured consumer loans are a risk position for banks in the retail business, unlike mortgage financing, which we just discussed in the other segment. Banks are cautious, especially when it comes to taking on consumer credit risks. This is something learned from history. In recessionary environments, there is also repeatedly an increase in unemployment. One reason why people are unable to meet their credit obligations. And in this respect, banks have significantly tightened their lending rules in this market. We are specialists in a secondary market for installment loans. So anything that an individual bank does not want to keep, it can broker to other banks. This particular market comes under pressure when lending regulations are tightened. And in this respect, you can see the very positive development we are experiencing as we roll out to additional partners across all 3 groups, that is, among private banks, the cooperatives with Genoflex, and also the savings banks. Unfortunately, not in corresponding growth figures, because we are increasingly less able to achieve a match between the credit needs of consumers and the risk appetite of the banks. So this is currently a particularly challenging market environment for us, and yet we are still operating very profitably here and maintaining our volumes. All in all, this means that for the financing platform segment, we have maintained our growth trajectory in the first 9 months despite headwinds. That is a strong performance and a great success, driven especially by the residential real estate segment, but the other 2 are also doing everything they can in this market environment to participate in this growth. So with that, we come to the last segment, insurance platform. As you know, here we also serve 3 submarkets, the standard tariff-based retail business, industrial insurance, and in the middle, occupational pension scheme. In all 3 segments, we generally look back on a very stable market environment. This is always helpful, especially when things get turbulent in our primary market. On the other hand, this very stable market environment over decades has also led to a certain inertia, particularly in the area where we operate, in the technical structures and IT systems of the industry. And for years, we have been fighting against this inertia and continue to see only low growth rates. When it comes to establishing our platform in the market, we are making progress. It's a lot of work, a lot of sweat and tears, you could say, but in all three product areas, there is progress in all the important projects. Unfortunately, monetization there is also repeatedly lagging behind. By switching our pricing model entirely to transaction-based models, we are also foregoing historical revenue that has a short-term effect. That hurts a little. Overall, the segment is now moving along the black zero line. We are still expecting a positive result for the whole segment. Starting next year, things should move a bit faster here when it comes to earnings. So with that, we've gone through all three segments and are now looking at the group level. As mentioned, strong numbers for the first 9 months. Earnings have doubled as expected after 9 months, so we are on track. A historical classification. With the new monthly figures, we confirm that for this year, in terms of revenue and gross profit, we are already expecting a record year and will thus outperform 2021, when we had a completely different market environment in all segments. This is a huge achievement for our business models and for our employees here, that we are able to accomplish this despite a primary market that is 30% smaller. To generate even more gross profit from it in the meantime, on the other hand, costs have continued to rise. Wages and salaries have increased since then, in line with inflation, or even more so, especially for specialists. And our operating expenses have also continued to develop rapidly. So here, the divergence in real estate prices, you could say, as the basis for the market, for the number of transactions and new construction activity on the one hand, and the cost of operating our platform on the other hand, is still something we are feeling. Therefore, this year will not be a record year in terms of earnings, but that's what we're aiming for next year. So, speaking of next year, how will things continue in the German market, especially with regard to our core market of home ownership? We are certain that there will not be any significant deregulation of the rental market in Germany, and as a result, the supply of rental housing will remain low at its current level, which for many middle-class families with average incomes has become extremely unattractive. In contrast, there is an attractive home ownership market, which is very well stocked outside the metropolitan regions, and even within the metropolitan regions, there is still supply, unlike in 2021. And therefore, the chance to meet your housing needs through home ownership is currently much greater than through renting. All of this is also associated with an adjustment of rent levels in the rental market. We are seeing sharply rising rents. Therefore, the economic attractiveness of an affordable rental market is no longer present. And thus, looking ahead, we expect a market situation where home ownership will benefit disproportionately. Based on this, we expect that with a stable interest rate level, which we also have to assume, the prices for home ownership, both for condominiums and for houses, will continue to rise dynamically. This means at the current pace of around 5% and thus above the inflation rate in the area of new construction costs, and therefore also as an alternative to purchasing existing properties, we anticipate a dynamic cost development slightly above the inflation rate because ongoing additional regulations will continue to drive up construction costs. And from our perspective, this means increasing values per transaction volume for the coming years. Due to the number of rental transactions that are no longer taking place, meaning that people are moving less for rental reasons and are increasingly moving into home ownership, we expect a significant expansion of our primary market, namely the financing of home purchases. We also finance the purchase of rental apartments, but in that area, especially for those acquiring portfolios, it's rather less common. Those who purchase individual apartments, of course, also go through Europace. And yet we still benefit from this because the professionals who do not finance through Europace are dropping out. There is a growing demand for home ownership in Germany. All of this will be further complemented by a revival of refinancing activity in the German market at the latest from 2027, when the loans concluded before 2012 with 15-year terms come back onto the market. And we also expect that investments in existing properties to improve energy efficiency and to achieve CO2 neutrality by 2045 at the latest will, sooner or later, have to increase. Depending on this, we expect a range for our core market of 75 to 100 billion euros per quarter. So the more investments are made in energy efficiency, the more likely it is to reach 100 billion. If investments in energy efficiency remain at the current level, then in the coming years we will only find ourselves just above 75 billion in this market. Overall, this represents significant growth compared to the current market volume, which is somewhere around 60 million, and thus offers further potential for the development of our revenue and earnings structure. Exactly, because Europace continues to gain market share disproportionately. This means that in this strong market, we will also continue to grow dynamically with Europace. This is essentially an indexed representation. And gain market share in all four areas, that is, in the three associations and the fourth segment, brokers. There is no alternative to Europace for this industry. AI is an enormous accelerator for our development. Based on our data, we can dramatically improve the services for our partners. There is no opportunity for anyone else to enter this market. And in this respect, we also see the disruption currently sweeping through our society is seen by us as an opportunity to further cement our role in the home ownership market. For this year, we have just adjusted our forecast regarding revenue and gross profit. In the Starpool joint venture with Deutsche Bank, we saw less revenue in the first 9 months and no longer expect a turnaround. And as a result, we had to revise revenue and gross profit downward there, and consequently also had to revise our group figures downward. This has no impact on earnings because the joint venture is structured in such a way that the result is essentially neutral. So with regard to the group's overall activities and overall economic success, we are sticking to our assumption that we will generate EBIT between 30 and 36 million. As is often the case, the fourth quarter will be decisive. Of course, it will determine exactly where we end up. It has just started now, and the critical phase is coming up soon. What is more important for you and for assessing Hypoport as an investment is how will things continue after that? We are confident that we will continue to grow at double-digit rates both at the top line and in earnings. For next year, we are aiming for a record year. We want to surpass the 48 million euros EBIT from 2021. And from this record year in 2026, we plan to continue growing dynamically, just as you have come to expect from us in the past. So